How does a real estate investor look at a changing market? Stay tuned. Welcome to this week's edition of Note School TV. Well, where every week we bring you the most amazing content as well as the most amazing guests. And again, this week is no different. We have an amazing guest he's from Boise, Idaho this week, and we'll bring him on in just a minute. But before we do, let's talk about, make sure that you like this episode. Yes, go ahead as you're watching it and hit that like button. And if you have not already subscribed to Note School TV, go ahead and do that. We're going to have our third year of episodes starting here in end of September. So we'll have to do a big show for that, and then make sure and hit that bell notification. Boom, go right ahead, do it now, and hit that bell notification. Also, keep your comments coming, guys. We love to hear from you. We love to hear what you're thinking, what's going on in your market. So please share that with us. What do you think of the shows and what you'd maybe like to see on an episode? So please keep those coming in as well. And to learn more about what we do at Note School, simply go to noteschool.com/TV. Again, noteschool.com/TV. And we would love to have a conversation with you and get you to one of our 2-hour master classes. More about that at the end of the show. So with that, I am going to bring on our esteemed founder, Chief Visionary Officer, all-around good guy, my friend, Mr. Eddie Speed.
Good morning.
Good morning. Good morning. How are you?
Well, Joe, on our little news segment today, letting the audience know we've changed our format. There's so much happening. Joe and I decided to make a little news segment for about 8 or 10 minutes before we have our guest on. Now, we have a great guest today.
Yes.
But Joe, our news segment today has the word banking and seismic shift in it.
Yes, absolutely. And by the way, guys, Eddie and I kind of compete every week about who's going to find the best news article. So that's just a little insider information there. But yeah, anytime you see banks and you see seismic, cusp, and then seismic, and then pain, it kind of makes your stomach tighten up a little bit.
Yeah, no kidding. So let's show the headline here. And so CNBC, this was a couple of days ago. CNBC had an article that came out. We'll put the link in here. There's a great video in here, by the way.
It really is.
In this article. The American banking landscape is on the cusp of a seismic shift.
Yeah.
Expect more pain to come. All right. So, Joe, that's the headline.
That's the headline.
Let's talk about what this article said and what it was about. We're going to start. There's so much of this stuff changing right now, guys. We can't wait till the end of the month to start telling you stuff. And it's so much of a story that starts driving our mindset. So, Joe, let's talk about this article.
Well, one of the first, and by the way, Eddie did win the thing this week. So just wanted to let you know. What are the banks doing? They're talking about having to clean up their spreadsheets, but their balance sheets, Eddie. Yeah. Meaning that with losses in commercial real estate, they're underwater on some of the bonds that they invested in, and capital flight is what it talks about, with banks with money being pulled out of the smaller banks and then going into the bigger banks. So there is a lot of headwind that the regionals are up against at this point.
This is a big deal.
It's a big deal.
When I have said, Joe, for now the last several months, if the note buying business was a 2 last year, right, we're at a 6.5 this year.
Yeah.
Okay. And people say, why is that true? Like, why all of a sudden does the discount note buying business go from really struggling with inventory, to a lot of inventory in front of us and a long runway of inventory.
Right.
And I made this point a few shows ago, but this article absolutely supports why we're saying this has happened to us.
Right.
Banks are selling assets and they're forcing their clients to sell assets.
That's right. That's right.
Inventory of notes, when the banks are saying, no, don't sell, we'll loan you money against them. And then all of a sudden they're like, no. And then all of a sudden the banks are going, oh, we need to clean up our balance sheet. We need to sell loans that have been charged down or something like that, or some kind of a ding on them. And so this is why we're seeing loans being sold. Joe, there's a significant supply of re-performing loans that banks have held on their books.
Absolutely.
These loans are paying again, but there were loans that were in default. We're talking about millions of loans.
Yes, we are.
And these are on residential properties, and we've seen a significant supply of these loans come down the pike to us.
That's right.
The other thing is we're seeing more seller finance loans.
That's right.
Particularly portfolios. Why? Because the guys that were seller financing property over and over were borrowing money at the bank last year, and now the banks have choked back, and now they say, well, we need to sell loans to create some liquidity.
That's right.
So when banks are in trouble, the note business has been better. That is a truth that started when I entered this business in 1980. In every cycle that's happened, that's been a truth.
You know, Eddie, and one of the things that's pretty significant, we know that back, you know, when people were entering forbearance programs, there were 8.5, almost 8.6 million families or houses entered into a forbearance. And that's where we're seeing all of these re-performing loans that are coming into the system. That's where they're coming from, significant amounts. And
so, Joe, how big is the banking problem? That's what this article's talking about.
That's right.
We're talking about what has happened. That could be true if the fish was this big, Joe.
Right.
Or it could be true if the fish were this big.
That's right.
How big is the fish?
It's a pretty sizable fish. It's like, yeah, let's pull it back some more so it'll make it look bigger. And of course, what has exacerbated this is that earnings reporting season kind of starts later this week as far as bank earnings for the second quarter of 2023. So there's going to be some things that are going to be uncovered as far as what you're saying, as far as liquidity. And there's a lot going on.
The banking world is definitely a world of haves and have-nots.
That's right.
Okay. We're not saying every smaller regional bank is in trouble.
Mm-hmm.
What we are saying, the article said, lean up and listen. The article said that 50% of the smaller banks are going to get absorbed by larger banks.
Right. Yeah, one of the quotes.
I don't know what you think's dramatic, Joe, but that's pretty dramatic.
50% is a big number. So that's what one of the quotes from the article here says. Some of these banks will survive by being the buyer rather than being the target, and that's exactly right.
All right, so Joe, there's something that's really relevant to this and relevant to why we thought this article was newsworthy. First of all, there's a lot of problem banks.
Mm-hmm.
They very specifically talked about in the article and the video of them selling loans, which is what we've been talking about.
Right.
And so this is only the tip of the iceberg. Yet to come is going to be a lot more inventory, a lot more opportunity. And the other thing that we have said is this is the most dramatic factor in the commercial real estate crash that has been forming.
Right.
Because the banks, these banks, not the top 25 banks, but banks below the top 25, those banks, which are, by the way, thousands.
Yes, it's the other 4,575 banks below. You know what I'm saying?
So you got about 4,600 banks in the United States, and it's not the top 25 that's the issue; it's the one below. And what they're saying is that now all of a sudden the examiners are starting to really, really scrutinize these smaller banks.
Right.
They basically said, Joe, that banks of 250 billion down to 100 billion, they've had a level of monitoring.
Right.
They've admitted that now banks below that size have not had the level of monitoring.
Yeah. Banks below $100 billion in assets have been, well, they've been kind of almost overlooked, and they've been in their own little world for a bit now.
Now, we've talked about the run on deposits. Let's show this graph. Here's the total deposits of banks. Let's show this graph. Joe, the numbers come back up a little bit, but I'll guarantee you that the deposits have not been increased by the smaller banks.
They've just moved the cheese, so to say, Eddie. And, you know, the thing of it is with and what really happened with the Silicon Valley Bank back in late April, when you look at that, was that social media just accelerated the whole thing. It's basically social media said, you need to go take your money out of these banks, and boom, it was gone.
Look at the drop when all that happened.
Yeah.
You can see right here.
Gosh,
and once again, we had a chart on a prior show where we showed the difference between the top 25 banks and the other banks.
Mm-hmm.
Now, the deposits are coming back up a little bit, Joe, and so I want to acknowledge that they have had a somewhat of an increase. But once again, we are contending that increase, that's the one in the orange there that you see, that increase in deposits is not going to the little guys. It's only going to the big guys.
Yep.
And I know in my situation, my company's situation, some assets I have under management that isn't even my money, we've had to go make significant changes and move money around. So I can tell you that we have moved money from smaller banks to some bigger, more stable banks. And we've also split it up amongst a lot of other banks.
You have to.
And so we can kind of relate to that. So enough on the deposits there, Joe. Let's get back to the article again and talk about something that's really, really critical. And that is, okay, let's just say, Joe, that there's 4,600 banks and we get collapsed down to 2,300. Okay, FDIC comes in, makes a deal with the guy with the big cigar and says, okay, you're the big guys, you're going to absorb this bank. Joe, does that bank, that bigger bank that absorbs that struggling bank, do they take all of the assets?
Absolutely not.
Yes, it's called a putback.
That's right.
And what they do is they say, we'll take all the assets of this bank except for those. And Joe, those are our opportunities.
That's our huckleberry right there.
That's our huckleberry.
Yep.
And so those are loans that are delinquent. Those are loans that have been charged down. Those are loans that are deemed as problematic in various ways.
Yep.
And listen, this old rabbit has been to that briar patch before.
Thrown right in the middle of it.
And I like it. I know it. And this is going to be a big opportunity for us. Last point on this article, Joe, let's show this chart. This shows the number of banks in the U.S. versus other countries. And so when we complain about the big banks are going to absorb it, it appears that other countries have already done this.
Yeah. Well, look at the headline there. The U.S. has more commercial banks than all other G7 countries combined. We have 311 in the United Kingdom.
Yeah. So it is not abnormal as to what's happening, and we can argue about politics or if it's this or it's that or whatever. We can argue about that all day, but the truth of the matter is, Joe, it's not that abnormal.
No.
And we are where we are. So, Joe, let's summarize this article for me.
Yeah. So as Eddie said, what we're really looking at here, we wouldn't bring this up and say, oh, the sky's falling, unless we had the forward-looking outlook. And the article does say, Eddie, that this is going to take a little bit of time, right? We're going to be looking at this. It's not going to be like a flash in the pan, boom, it's done, it's over. It's going to take a little bit of time, which is good for us.
It's a long runway. This is why I'm saying that the things in this business are not some short-lived. 6-month story. This is several years in front of us.
Yes.
We are seeing more opportunity now than we have seen in years.
Mm-hmm.
And the deal is when you look at the level of banking, the level of assets, this is a long run in front of us. Joe, if I've ever reported for our industry good news, this is good news for a long time in the future.
And Eddie, just for some people saying, well, we're talking about JP Morgan Chase and these big banks. How does that relate? And how does that come to us? Eddie, it's nothing more than the trickle down theory, right?
It is. Listen, there's going to be hedge funds that are involved, and they're going to buy, yep, these assets, these bust out assets and stuff. But every time that happens, it produces opportunity for us. We're already seeing it. We've already had only a little bit of this has happened yet, and we've drastically changed our inventory. So I just thought it was an interesting article because it exactly exemplifies why we've been saying what we've been saying. So as enough said on that. I hope that's interesting to you guys. We're going to put the link to the article in the video. Yep. It's worth watching. The video is pretty dang good and pretty informative.
Yeah.
So we'll put it in the chat and you guys can watch it. So Joe, we have a very great guest today.
We do. Good man.
This guy has become our friend and just somebody we really respect. And in light of kind of the story of a changing world, we thought it would be really cool to bring somebody in that has lived through a lot of changes in their world in the last 5 years.
Absolutely. In an interesting market.
Very interesting market.
Yeah.
All right. Mr. Dan Walters. He is from Boise, Idaho. How you doing, Dan?
What's up, fellas? Always happy to join two of my favorite fellows from the South.
There you go.
We are thrilled to have you, Dan. Dan is in Boise, Idaho. If you guys have done any research in residential real estate or any kind of real estate in the last 5 years, you have seen Boise at the top of the list, Dan.
It has. Yep, it has been. It's been going on about 4 or 5 years now. It's
and then all of a sudden you fell off the list.
You did.
And then you became the most declining market in the country.
Yep. We're also the most overpriced, one of the most overpriced in the nation. So I think
it means least affordable and all those other things.
Yeah, exactly.
Dan, I'm going to jump off here and let you and Eddie kind of talk for a few minutes, and I'll see you back on the backside.
See you, Joe.
So one of the things, Dan, is, I know that when we come on this show that we are constantly talking about change and disruption and turmoil, and this is booming and this is not, and so we just thought it would be fun. You've been on the show with us, a few times already, so my audience may know you. One of the things that we always try to relate to, Dan, is you're a pretty seasoned investor, right? Not every one of our audience is as seasoned as you. And so we're looking for you as kind of an advisory role today. Guys that don't have your level of seasoning, or maybe they do, what have you learned?
Yeah, I appreciate that, Eddie. I think, over the years, I think, this is probably my 15th or 16th year in the business. And we have seen a lot of changes. But for me, it's always been when something happens that I have not really experienced, because obviously when I first got started, I didn't know what I didn't know. It was always, okay, if something were changing, I was always seeking out people that had been in it for years, that have seen true cycles. I think I'm at this point now where I've actually seen a full cycle from when I got started back in 2008 to now. I think I've actually seen the full rise and the fall, and then up and then the up again. But it's always been, okay, what do I need to do now to pivot, to add to my tool belt to be able to still continue in my core business and what I'm trying to build inside of my real estate business? So whether that's a technique, whether that's a strategy, whether that's an addendum, whatever that may be, it's always seeking out, okay, talking to people that have been in the business for a long time, but more importantly, asking them, have you seen this before? And what did you do at this point when this happened? And then what strategy do you feel works well, whether it's on the acquisition side, on the disposition side, doesn't matter. But that's been the biggest thing, is what can I add? What don't I have that I'm not doing now that can help me continue to be successful and not burn out and disappear? Like we've probably seen, like I know we've seen in our market, in our industry, a bunch of people that were doing pretty, rolling pretty fat from 20 to 22. But in the last 6 to 8 months, it's kind of hit them pretty hard, and some of them aren't doing it anymore.
So, Dan, the internet has been great for the business in some ways, and for other ways, it's been detrimental because information travels really fast.
Yeah.
You and I know a lot of the top 500 house buyers.
Right.
And they had buying machines, and they kind of quit rehabbing and just started flipping contracts. Why were they doing that?
Because it was easy. It was making them money.
And there was a bigger fool than them.
Right. Yep.
And that was called Wall Street.
Right. Yep.
Now all of a sudden they've left, and flipping contracts is fairly unrealistic.
Yeah, I mean, it's certainly a lot harder than what it was. I mean, people actually have to work.
What would have happened to you in this change had you not been able to do creative financing?
It would have drastically. It would have cut my business probably between close to 40% of what I'm. It's a large majority of what we are doing today, especially in the last 8 to 12 months. It's been interesting. Since I've joined Note School, that's when we joined like in 19. So this was right before the big ramp up.
Yeah.
So a lot of those conversations we were trying to have, I mean, we were getting into some of them, but it was very few and far between. And now I've been telling now that I've been training my acquisitions people on it, I've been telling them, like, look, it is coming. Just be patient. Keep having the conversation. And now over the last 8 to 12 months, we're starting to really see the fruit of that labor inside of that, in these conversations. But it's been a huge part of my business now. And if I had not added that, we wouldn't be having the inventory, the leads. We wouldn't be able to convert the leads that we're talking to, because it just wouldn't make sense. So it's been a significant addition to our business. And for those that are entering into it now and getting started and are adding this to their tool belt out the gate, you're at a significant advantage. I believe that most of your competition that's not having that's not adding this tool to their belt.
A marketing guy that you and I consider, we respect him of his marketing brilliance, named Frank Kern.
Yep.
He has a saying. He says, "Dispel your disbelief."
Yep.
And so there's a lot of real estate investors, big and small, that think creative financing doesn't matter. You don't need it. It's too old school. It's high. And the truth of the matter is, we just heard you say that it would have affected 40% of your business had you not been able to do it. That's pretty big.
It's like you said in the news update, right? I mean, 50%, that's dramatic, right? I mean, if that's not dramatic, I don't know what is. And 40 to 50% is a pretty dramatic number. So yeah, absolutely.
Yeah, it's a big thing. And, we Note School trains a variety of people. So Note School has people that are bigger, older, seasoned operators like you. And then Note School has people that are new and trying to get into it. I guess I want to focus on that for a minute. Let's just say that somebody's not you. They've not been doing it for 15 years. They don't have they don't have all the resources, all the things that you have. And, like you and I started in 1980. I entered the note business. You probably couldn't have picked a better time to go throw a dart and say, enter it right then. Banks were falling apart. And inflation, all this sounds familiar. And all of those things were driving opportunity, but not for most people in real estate. Most people in real estate were screaming. The people that were doing well were people that understood how to think differently. I think we've entered a think differently market.
Yep. 100%.
What does that mean?
Well, for us, I mean, for me, when you say that, I go directly to when we're actually talking terms. When we're in a market like we are, regardless of the indicators you look at, all the resources that we look at as far as what's going to happen in the future. I mean, we don't have a crystal ball, but we have indicators that dictate, right, of what may happen. But there's no guarantee that that's going to happen. I mean, we thought when COVID hit and everything shut down that was going to be the black swan that crashed the market. It was just the opposite. So I think for me, when you say that, what I come down to, I come down to the terms, and what this has taught me and has been able to implement in uncertain times. It has allowed me to control what we can, when we acquire it. We can control the terms that even if the market takes a massive tank, we still have favorable terms that can be a profitable asset for us. That's one of the biggest things that has given me a lot of comfort and security in utilizing these strategies, is being able to dictate favorable terms, because now we're not beholden to a hard money lender at 12 or 15%, at 80 or 90% of the market value, and getting caught with our pants down when the market turns left and goes south. We actually have very favorable terms. And even if those terms end up not being as favorable as we thought they were, we can go back, and because we have that personal relationship, we have that rapport with that seller and that note holder, to be able to possibly negotiate those terms into a more favorable situation for both parties. So for me, it's just given us more comfort and in the ability to control the terms of how we're acquiring, and allowing us to look to the future to know that we're going to be in a good position regardless of where the market goes.
I had a guy that brought me a large deal. It was a storage facility deal. It's a big deal, $8 million deal. And he hired me as a consultant to help him structure the deal. He knows me. He's in another mastermind, big operator. And once again, real estate investors, they learn a little bit about terms, and they just understand it. What I know how to do, what Joe knows how to do, is an art. What you now know how to do is an art.
Correct.
You can't teach an art. You can't teach an art in a chapter of the book. So what we've learned to do is, that's when people, we teach them how to bring the right stuff to us, and then we take those components and help mold it into something. That's what this guy did. And I can make pretty good money when people bring me big deals, because I'm going to make them a lot of money, and my hourly rate's pretty amazing, and it works. It's a win-win, right? Guy brings me a deal. He's overpaying by $1 million. The guy, there's an older couple of guys that own it. They need to sell. He's overpaying by $1 million. The seller is willing to carry terms, but the seller wants almost 5% interest. And at 5% interest, quite honestly, the math doesn't work.
Mm-hmm.
And he says, what do I do? So I helped him configure a structure, and I'm going to admit to you, it's got a couple of wrinkles to it, right?
Mm-hmm.
I helped him configure a structure and paying some of the debt now and some of the debt later, and structuring it kind of two different ways to take the effective interest rate below 2.5%. And when he ran the cash flow, it worked great. And I said, see, you can overpay. It's just a matter of how you pay it.
Yep. Yeah.
That's what you have mastered. You've become very good at this, Dan.
Absolutely. Yeah. And we're still learning. And that's what's great about, this is what is fun about that art. It's about the art component to this strategy. And I talk to this to my acquisition people all the time. I'm like, look, there is a science to it, as long as there's a foundational science to it, but then there is the art of moving this thing along into that rapport with that seller, really understanding, getting down to what the what's and the whys, and then crafting that into getting them what they want. But at the same time, it really makes financial and sense for us to be able to move forward and acquire that thing. And regardless if we overpay or not, whatever the term is, but we still have favorable control and favorable terms that allows us to make money year over year for, and truly generate passive income. And that is what has been so great about this, and that keeps me so excited about entering into this, I mean, I'm more excited about doing the creative stuff than we are the cash deals. I mean, the cash deals are great because we get equity, but man, with what we do on the creative side, we know we're going to create the equity at some point, like with the, buying our debt back in the future. I mean, that simple thing in and of itself has been a game changer, so it's
my guy that ran my marketing. I was telling the story yesterday about this deal. And he says, how much money do you feel like he made because of what you helped him with? And I said, well, pretty much he can't do the deal the way it is. So let's say 0 on one side, and probably over the next 10 years, this thing's going to make a few $1,000,000. He said, are you saying that you helped a guy make a few $1,000,000? I said, well, I didn't do it on my own. I think the guy's a good operator and he's a smart guy, but he had a deal that was going to go from he can't make money on it and he wasn't going to close on it. He's not going to go risk his financial future. He's about your age.
Mm-hmm.
Dan, and he's not going to go risk everything he's got on one deal to go find out he's worked for all these years and blow himself up. He's smart. He's not going to do that.
Right.
And so on the other side, it's kind of like, is it possible? And the answer is, for you who have now, we've had a lot of fun times together breaking up deals, and it's possible. So I was going to ask you one thing. You saw our big thing about the banks, right? Our whole intro about the banks.
Right.
We've talked about it. How do you become the complete investor, right? And one of the ways that I think you become the complete investor is now all of a sudden you see yourself in a position to buy notes that hasn't really been on the front of your radar anymore in the past. Right.
Yeah. And I think that's something that we've always, that I've always wanted to, it's been one to really become more of a passive aspect to my business and making that more of a front working component. And I everything that we've been looking at over the last few years just hasn't seemed right for us. And now the conversations that are having, the opportunities that we're looking at that are coming across, the portfolios that we're looking at to evaluate. I mean, now it's like, just like you guys were saying at the front end of this, now it's starting to really feel like that there is a lot of opportunity to really, dive into this on the note side and really just utilize or take advantage of what's happening in our market and what's to come here in the next couple of years, for sure.
I was having a conversation yesterday with a very name brand person. A lot of our audience would know their name. And I said, it's just like the multifamily thing, right? Multifamily is not rescued from the rest of from commercial real estate. It's been reliant on smaller and regional banks making loans. 70% of those deals have been financed through banks other than the top 25 banks. And
Mm-hmm.
guess what? It ain't no surprise. They're already stopping making loans, period, or they've drastically changed their underwriting, and that's more of that to come. And that in lies, when there's not money to fund a business, the business really gets in trouble. And so those opportunities are, but Dan, we talk about passive investors. Our biggest competition are people that have invested in multifamily. And when they can't find multifamily deals that make sense to invest in, guess what they're going to want to do with their money?
Yeah, they're going to want to throw it into notes and what else they can, right?
They're looking for the alternative to the more traditional alternative. So that's exactly what I see. And you and I have talked about forever. You're building your own bank, and that's really kind of part of the process of doing it. So, Joe.
Dan, I was making some notes. I keep notes is what we talk about on each show, and what I just kind of put in was for what you had said to kind of make it smaller, was that what you're doing has made your business. Think if you hadn't have done this and you would have been in that fickle business of having to compete in the wholesale space, right? And now what you've done is by doing this, you've created a business that's a long-term business that's sustainable and will build wealth into the future. And that's what every business should do, right?
Absolutely. Yeah. And I think, well, for me, that's always been my core business. And then when we ran into, 1920 in the last, through basically end of 19 through 22, I mean, we got kind of, I don't want to say forced into it, but it's just kind of what it was. And so we got caught in the wholesaling, the flipping side of it. And it's a grind, man. It really is. There's a lot of stress to it. I understand there's systems to be built around it and people make a business of it, but man, when things happen like this, if you're not set, if you don't have any other things coming in or any sort of other passive assets and, that are producing for you, it makes running business really stressful and really hard. And so I think what we built prior to this and that blip that we got caught in with all the fix and flip stuff, I mean, it was great, but at the same time, I'm glad that I stuck to, my core business and what I really wanted to be, and just and kept investing in it, knowing it was going to come back around, but I just had to be patient for it. But yeah, I love it. I love it.
Well, we just got through with a 3-day class on Sunday. And if I said it once, I said it 100 times. And that was, this is the business that you do the work one time, right? And you get paid for a long time. And I love that. And certainly if you were to ask probably anybody that's watching today and said, hey, what do you really want out of a business? They wouldn't say, well, I want to go out and flip houses, or I want to go out and be a rehabber. They'd say, I want passive income.
Yeah.
And Dan, you've mastered that, dude.
Well, I wouldn't say master. We're still working it, but
it's a daily learn, right?
Yeah, it is. But
I'm going to conclude it by this. Dan was a visionary for his business. Yes. And the reason that he is because he entered into creative financing when a lot of his competition wouldn't have even considered it.
That's right.
If you now look back, had he not done that, he would have killed himself, maybe not gone out of business, but definitely been really wounded, certainly not thrived as you have.
Well, I agree with that. And I think even if I would have pivoted to it at, in this year or last year, I wouldn't have been as well versed in the conversations that I would be having. A lot of the similar conversations our competition is, as far as providing this. It would be very similar, just kind of like a wholesale deal is. I think it'd all be very similar stuff. Yeah. Where we've been working at it for so long and having the conversations for so long, that now when we come in, we're actually tailoring something to fit the actual seller. That's I think is vastly different than what a lot of the competition is.
Well, and I'm going to say this, Dan, we've got a lot better at teaching it.
Yeah, you have. Yeah, it's been night and day difference from 19 till now.
I mean, so we've taken a little bit of the artist out, where the student doesn't have to be quite the artist. And so you guys were helpful. We made a good partnership.
Absolutely.
We were pretty diligent in making sure you could figure out the ways to get deals done, and you taught us the reactions and the responses of not only your customers but your sales team, and that it was invaluable.
Well, and I think that's a two-way street. I think that everything that you were teaching us was invaluable as well, even though we didn't know at the time what you were, exactly what we were applying. But now over the fruits of the labor are starting to kind of manifest themselves. Like, oh, wow, that's significant. So yeah, it's
all great. Right. Well, I'm going to probably get to Boise, Idaho, as you know.
Yeah, come on, we got room for you. Just one.
My daughter and son-in-law are moving to Boise. She is going to dance in the ballet company there.
That's great.
Yeah. So we'll look forward to getting up there and hanging out with you.
Sounds good. We'll look forward to it. I appreciate you guys having me on as always. And if there's anything else you guys need from me, I'm happy to help. So
have a good vacation next week, man. Enjoy the boat and the family.
I will definitely do that. All right, guys, be well.
All right. Appreciate it. So I just want to close out by saying that every week when I introduce Eddie, I always say that, well, he's our chief visionary officer. So had Eddie not seen this kind of identified this piece of the market, this creative buying and selling on terms and working with that, we'd be having a whole different conversation today with a lot of people. So when we say we're, Eddie's out there looking, he's the visionary. That's exactly what we mean by that. So with that, we'd love to have you at one of our 2-hour master classes. They're done by Eddie and our Chief Market Officer, Max Keller. And we'd love to have you come. You'd be our guest there, no charge for you. But if you want to learn more about how to do that, just simply go to noteschooltv.com noteschool.com/TV, noteschool.com/TV. And in the subject line, or just let us know that you want to attend one of our 2-hour master classes, and we would love to have you and have a conversation about what it looks like. So with that, thanks so much. We will see you same place, same time next Wednesday at 11:05 Central Time. Have a great rest of your week.